Welcome back to our channel, where we make investing easy and accessible for beginners. Today, we're diving into the world of investing and breaking down complex concepts into simple, easy to understand terms. Whether you're new to investing or looking to brush up on the basics, this video is for you. Before we jump into the nitty-gritty, let's start with the foundational concept of investing. What is investing? Simply put, investing is the act of allocating your money to an asset with the expectation of generating a return or profit over time. Now, let's break down some common investment vehicles you'll come across. First, we have stocks. Stocks represent ownership in a company, and when you buy a stock, you become a shareholder. Stock prices can fluctuate based on various factors like company performance and market conditions. Next, we have bonds. Bonds are debt instruments where you lend money to a government or corporation in exchange for regular interest payments and the return of the principal amount at maturity. Moving on to mutual funds. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They're managed by professional fund managers. Lastly, we have index funds. These are a type of mutual fund or exchange-traded fund, ETF, that aim to replicate the performance of a specific market index, such as the S&P 500. They offer broad market exposure with lower fees compared to actively managed funds. Now that we've covered some key investment terms, let's discuss a crucial concept: risk and return. In investing, risk and return are often interconnected. Generally, higher risk investments have the potential for higher returns, but they also come with a greater chance of loss. Lower risk investments, on the other hand, tend to offer more modest returns but come with a higher level of stability. To manage risk and build a solid investment strategy, it's important to diversify your portfolio. Diversification means spreading your investments across different asset classes, industries, and geographic regions. This helps reduce the impact of any single investment's performance on your overall portfolio. Now, let's touch on another vital aspect: investment time horizon. Your investment time horizon refers to the length of time you plan to stay invested. Longer time horizons generally allow you to take on more risk and potentially benefit from the power of compounding. Shorter time horizons often call for a more conservative approach to preserve capital. Finally, let's discuss the importance of conducting research and staying informed. Before investing your hard-earned money, make sure to research the companies, funds, or assets you're considering. Look into their financial health, performance history, and any news or events that may impact their value. Additionally, staying informed about market trends, economic indicators, and investment strategies can help you make more informed decisions. And that concludes our breakdown of complex investing concepts for beginners. Remember, investing is a journey, and it's essential.